Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 strong buy stocks to consider adding amid a market pullback. So we're going to take a broader look at kind of the market, some of the second quarter earnings results so far, and then what to expect going forward before we dive into these 3 stocks, just to give people a better sense of why we're taking a look at these 3 stocks and what's, as you said, what's going on in general. So stocks fell on Monday as part of a recent pullback after all 3 major U.S. indexes had reached new highs to start the third quarter. So as of around noon central, we had the Dow down about 2.5%, with the S&P down about 1.9% and the NASDAQ down about 1.4%. So some big pullbacks. Monday also saw the continuation of falling bond yields, with the 10-year U.S. Treasury down to about 1.2% at one point, which was its lowest point since February. So these falling bond yields are being caused by a multitude of factors, which include some technical moves lower, which feature some short covering. There's also the possibility of peaking economic growth, lower summer supply, and a return to safety globally amid some growing concerns of COVID outside of the U.S. And with the 10-year U.S. Treasury is really the safe haven of the global economy. So all of those factors are contributing to those falling bond yields as people dive back into that 10-year U.S. Treasury and other U.S. Treasuries. So the decline over the last 6 weeks or so had coincided with that resurgent tech sector that had driven the NASDAQ up and all of these huge tech names back up to new highs. And long-term investors clearly need to remember that lower yields theoretically mean higher stock prices. And even when the Fed starts to raise its rates in the next couple of years, or whenever that those rates actually start to get slowly risen amid all of these inflation concerns at the moment, they will still remain historically low for the foreseeable future, which will prolong that there is no alternative investing, as Wall Street and investors are left chasing returns in stocks when, even if, say, the 10-year goes up to 2% or above, most people are going to be looking for higher returns than that. So now we're going to before we jump into these 3 stocks, we're going to just do, as I mentioned, some more market happening. So retail sales popped about 0.6% in June compared to May. That was based on Commerce Department data that came out on Friday. This top projections, but it's worth noting that marked growth against May's decline. But it was positive because some economists had projected there was going to be another decline in June. So up 0.6% is solid. Despite that positive June retail expansion, there is a little bit of a drag in consumer sentiment at the moment amid these rising prices and inflation worries. So people are a little less bullish in terms of that consumer sentiment than they were at the moment. That said, the nearly completely reopened U.S. economy is still surging overall, and those early second quarter earnings results and guidance are highlighting that broader strength of the U.S. economy. So the S&P 500 is projected to post strong earnings growth against that pre-COVID period in FY19, and the numbers are projected to keep improving. So at the moment, the Q2 for S&P 500 earnings, Q2 results are supposed to be up about 14.5% from the pre-COVID period. So real growth of nearly 15% growth projections for the pre-COVID period. And we're up at the moment, we're calling for about 70% growth compared to those easy compare periods last year, with more growth expected in Q3, Q4, and Q1, and then going on into 2022 and beyond. So overall, the U.S. economy is projected to expand by between about 6.5% and 7% this year, and then north of 5% in 2022. And this is via my boss and the director of research here at Zacks, CHWY. He wrote last Friday in his earnings preview that, quote, we typically associate these growth rates, referring to that U.S. GDP growth I just mentioned, in these ranges, with emerging economies not ones mature like the U.S. market. We still remain confident that actual growth will surprise to the upside relative to current expectations, but these consensus projections nevertheless qualify as boom times ahead in our worldview. So despite some recent pullbacks, we're still expecting a booming U.S. economy through the rest of 2021 and 2022, and maybe even beyond that. So despite these inflation worries, Wall Street had pushed stocks to new records, as we mentioned, to start Q3, as they jump back into technology. That recent push saw many tech names, including just that widely popular NASDAQ 100 tracking QQQ, rise above overbought RSI levels, so over 70. And the recent pullback then seemed relatively due, which we've seen over the last several days, as a healthy recalibration as stocks reached a little bit of frothy levels. So with that in mind, investors might want to also use Q2 earnings season as a chance to take profits, so we could see more selling, even if results continue to be impressive and guidance is strong. This could just be a time to take profits after we saw stocks run up to new highs to start Q3. With that in mind, the market is still poised to remain strong, as Wall Street, as we mentioned, for all these reasons, will be left chasing returns in the near future and trying to time the market, as we've seen over the last since COVID happened, is very difficult because it can often lead to, say, buying high and selling low, and if you miss these quick jumps back higher, as we said. So if long-term investors trying to time the market can often just lead to less advantageous buying patterns. So with that in mind, we're going to take a look at 3 strong buy Zacks stocks that are worth considering amid this broader market pullback that might be worth long-term investors buying now, despite some near-term concerns with the market for, as we said, long-term holds that look to be ready for years and years of growth. And we're going to start with Chewy, which trades in the ticker CHWY. Chewy is an e-commerce pet store that went public in 2019 and has expanded pretty rapidly as consumers gravitate towards convenience wherever they can. The firm sells pet food, supplies, treats, medication, and more for a variety of animals. And Chewy has found success, and this is really the key point, by adding loyal pet owners to its ranks, with about 70% of its sales coming from its auto ship business that allows people to have food and more delivered at regular intervals. I can say my wife and I have a dog, and we get her dog food delivered automatically by Chewy. Comes, I think, every 3 weeks, maybe every month. And it is very convenient. So as you get near the end of that dog food, the rest of the new bag shows up at your door. So Chewy added 43% more users in 2020 to close the year with over 19 million in that auto ship business, as you mentioned, which accounts for about 70% of sales, creates really consistent revenue streams. The company, which had been at it for about a decade, has also expanded its offerings. Last October, it launched its telehealth service called Connect with the Vet, and it's continued to improve that ever since. The company also has boosted its pharmacy offerings, and its expanded portfolio helps it thrive in an e-commerce world that's dominated, as we all know, by Amazon and now Target and Walmart and the likes. So the company topped our Q1 estimates in early June, with revenue and new active customers both up about 32%. So closed the quarter with nearly 20 million active customers, up 600,000 sequentially. And this is a quote from its CEO saying, quote, "Further, retention rates remain steady as the 2020 cohort matures into the second year on the platform. Taking a broader view over the past 2 years, we have increased our active customer base by 8.4 million or 75%. So that active customer base is really huge for their growth. So looking ahead, Zacks estimates call for its 2021 revenue to climb about 26%, or about 1.8 billion higher, to reach $9 billion this year, with a projected to add another 1.9 billion or 21% higher sales in 2022. So these estimates would follow 47% growth last year and 37% growth in the year before that. So just continued pretty impressive growth for Chewy. We should also note that Chewy reported its first quarterly profit in Q4, crushing our bottom line estimates. The company then followed it up with another impressive period of positive adjusted earnings in Q1. And Zacks estimates are calling for its adjusted Q1 2020, full year 2021 earnings per share to climb 11% and then skyrocket 210% in 2022, all the way up to 31 cents per share. We should note that its 2021 and 2022 consensus earnings estimates have climbed heavily since its report, and this helps it land a Zacks ranked number one strong buy at the moment. We should also note that 9 of the 14 brokerage recommendations that Zacks has for the stock are strong buys, so that helps give a better sense of where some Wall Street analysts are on the stock. More importantly, e-commerce was booming long before the pandemic, and people utilizing delivery, especially automated delivery for essentials like pet food, seem more unlikely to go back even as they return to their normal lives. It's just the convenience of having something as simple and uncomplicated as pet food delivered automatically is pretty straightforward for the company. So Chewy shares have soared about 300% had soared about 300% from their March 2020 lows to those February highs. They got up to around $120 per share. It then got hit pretty hard as Wall Street sold those high flyers. The stock then mounted a bit of a comeback after it fell below oversold RSI territory back in May, and it's still up about 60% in the last year. Yet it's currently trading around 35% below its records, which is still offering a solid entry point. Oh, excuse me. It's trading about 25% below its records and near neutral RSI levels. So it's also still trading at about a 50% discount below its year-long highs at 3.3 times forward sales. And the stock was nearing falling below its 50-day moving average as of Friday as part of a continued recent pullback, but then Wall Street clearly noticed this fact and it surged over 6% through morning trading the last time I looked on Monday. So some positive near-term momentum could be back in place. And as we mentioned, those with longer-term horizons don't need to worry as much about trying to time the stock, especially one that's ready to grow for years to come as it expands within a broader e-commerce world. And we all know in the U.S. especially that pet ownership is such a big part of people's lives, and people are willing to spend money, especially on convenience for their pets. So Chewy is definitely worth considering as a longer-term play, as it still sits 25% below those earlier 2021 records. And now we're going to look at another highly ranked Zacks stock, and that is Tempur Sealy, which trades in the ticker TPX. It is one of the world's largest mattress and bedding companies. It operates under multiple brands, including Tempur, Tempur-Pedic, Sealy, Stearns & Foster. It sells higher-end mattresses, pillows, more, and it offers everything from adjustable beds and cooling mattresses to high-tech beds that try to help reduce snoring. And as we all know, sleep is a big part of most people's lives, so people are certainly higher-income customers who might be prone to buying these Tempur Sealy offerings are willing to spend a lot of money to help improve their sleep, which can improve their health in general. So as we mentioned, they're selling products that really aren't going to go out of style, even as they adapt to new customer needs and develop new types of bedding. People still are going to always need beds. The company, like all retailers, has invested in its own digital and direct consumer business to fight against any encroachment from digital-focused newcomers and bed-in-the-box firms like Casper. Tempur Sealy also owns its own stores, and it works with third-party sellers like Mattress Firm and Big Lots and others like that. Its 2020 revenue jumped over 18% to about $3.7 billion to top FY19's 15% expansion, so some big growth in the last couple of years. It's also benefited recently from pandemic-related spending. And we should note that its sales soared well before the pandemic as well, with that 30% growth in Q4 of FY19. And more importantly, the company is poised to benefit from the continued booming housing market that's finally being driven by millennials. So beds and housing market kind of go hand in hand as people move from the city, maybe to find more space and more bedrooms. Often they're going to need to fill these bedrooms with mattresses. And we know that there's still pent-up demand, especially among high-income households, and this company is, based on our estimates, looks poised to continue to grow. So the company topped our Q1 estimates with revenue up another 21% and direct consumer sales up 62%. So our estimates are now calling for its 2021 sales to climb about 27% higher, from $3.7 billion all the way up to $4.7 billion, with 2022 projected to jump another 8% higher. Meanwhile, its adjusted earnings per share are expected to soar 48% this year and then climb another 14% next year. Its strong earnings revisions activity, like with all the stocks we're going to talk about today, helps it grab a Zacks ranked number one strong buy at the moment. And the firm has also crushed our bottom line estimates recently. And 6 of the 9 brokerage recommendations that Zacks has are strong buys, with none below a hold. We should also note that the company declared a dividend recently with the yield of about 0.7% right now. The company also upped its stock buyback program, and its shares have soared roughly 100% in the last year to outclimb its highly ranked retail home furnishing market that includes RH, which is formerly known as Restoration Hardware, Ethan Allen, and many others that are, as we mentioned, benefiting from this booming consumer spending and the housing market. So the recent run is part of a much longer run over the last 3 years that nearly doubles its peers. That said, the stock slipped Monday as part of a nearly 10% dip since it hit new records in early July. It's now trading just a few dollars below its early July records at around $38 per share. Despite this longer-term outperformance, the stock is trading at about 13 times forward 12-month earnings, which represents a discount to its industry's 17 times average in its own year-long median, and about a 33% discount to its highs over this period. And this is despite the fact that it's only trading about 10% below its records. So Tempur Sealy also sits now with this pullback near or below neutral RSI levels at about 45. And even though its stock price has continued to be up about 40% in the last year or 40% in 2021 to crush the broader market. So overall, long-term investors with a horizon of, say, a year or more might want to consider TPX at the moment, especially now with it pulling back from its recent highs, so you get a better entry point possibly. And now we're going to look at another stock that's soared recently that's also a Zacks ranked number one strong buy, and that is Nike, which trades under ticker NKE. It had underperformed the market in 2021 until it posted blowout fourth quarter fiscal 2021 results on June 24th. The sportswear giant stock has now surged about 20% since then to reach new highs, and its outlook is rather impressive, especially as we continue to mention for longer term investors. So let's quickly go over what they did in Q4 before we look ahead, since that stock soared after it released its Q4 results. So its sales jumped 98% against the year ago quarter, with that being that COVID hit quarter, and 21% versus the pre-pandemic period in its fiscal 2019 of Q4. The company also swung from an adjusted loss of 51 cents per share all the way up to 93 cents per share to crush our estimate. And the company's margins also climbed as its direct-to-consumer push gains momentum. Nike's direct sales popped 73% to about $4.5 billion. The company noted that 2021 was a pivotal year for Nike as we brought our consumer direct acceleration strategy to life across the entire marketplace. Fueled by the momentum, we continue to invest in innovation in our digital leadership to set the foundation for Nike's long-term growth. So they're going all in on digital and improving supply chains and everything, and going heavily direct consumer, which will help its margins going forward. So Nike's fiscal 2021 sales surged 19% to bounce back from a slightly COVID hit 2020 that pushed its sales down about 4.4%. Last year's top-line growth marked Nike's best in decades, pulling in about $44.5 billion, as it proves once again that it is the undisputed champion of that sports apparel world and that sneaker world in general, which is becoming more popular every day. And this is despite the rise of Lululemon and a resurgent Adidas in North America, along with other upstart brands that are continuing to pop up in this modern retail age where everyone's buying things directly on Instagram and other places like that. That said, it's certainly no simple task to stay at the top of any industry, much less one like fashion. And Nike continually ranks as one of the world's most valuable brands. This is alongside likes of Coca-Cola and McDonald's and Apple and others. And it's thrived because of its ability to create trends, constantly adapt, and attach that swoosh to some of the biggest sports and athletes and cultural icons in the US and around the world. As we mentioned, it's investing heavily in its digital future. This includes multiple shopping apps, an impressive digital marketplace that spans from its own websites to social media. And the firm has also spent, as you said, digitalizing its supply chain. This has come through acquisitions as well in order to be more predictive. And initially, the stock was hurt earlier in 2021 because some supply chain setbacks and shipping setbacks in Q3 that were part of a broader global congestion, but they don't appear to be hindering the company anymore, or certainly not at the moment. And Zacks estimates are calling for its revenue to jump 12% in FY 2022 and another 10.3% higher in FY 23, both of which would mark its strongest top-line expansion since 2012. And this is coming, as we said, after a massive year, this past year of its fiscal 2021. So the sportswear giants' adjusted earnings per share figures are both expected to climb about 18% this year and next year. And it's consistently beaten our bottom line estimates in this. Its longer-term earnings consensus have climbed since reported on the back of some solid guidance as well. Nike, as we mentioned, which was down in 2021, has soared 20% to new highs since that report. But it has moved sideways after that initial massive post-earnings surge, and it was down about 1% Monday morning to around $158 per share. And it's now also back under overbought RSI levels at about 67. So it had, along with much of the market, it had surged above little frothy levels. So there could be even more of a pullback. Still, the stock's up about 185% in the past 5 years to blow away its highly ranked industry and top the S&P 500. And despite sitting relatively near its new records, it's trading at about a 20% discount to its own year-long highs in terms of forward earnings, which also marks a discount to its median. Nike's post-release earnings per share revisions have helped it grab a Zacks ranked number one strong buy, and this is alongside some positive or some strong style scores. So it has an A grade for momentum. As you mentioned, there could be a near-term pullback given this impressive post-earnings run, but we've already seen a little bit more of a pullback so far for Nike and some of these other recent resurgent stocks. Still, longer-term investors might want to consider the stock, given that 16 of the 21 brokerage recommendations the Zacks has are strong buys, with none below a hold. We should also note that Nike pays a dividend, and it resumed buybacks last quarter, and longer-term investors really might want to consider Nike at the moment as a long-term play within this broader retail space as it invests heavily in the future and has seen real growth so far in its massive direct consumer business, and it continues to grow both in the United States and around the world. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.